Hi, this is Shane with The Rational Trader. It is Tuesday the 8th. On screen is my result for the day, minus $10. This is definitely a case where trading multiple markets can smooth out the bumps. All right, so if you were trading only gold, you know, that's a max loss day, minus 14 ticks or $140. If you were trading only the euro, that's a max loss day, minus 14 ticks, or whatever, 87.50. What is that? I can't do the math. Let's find out. That's hilarious. 6E minus 87.50. There we go. And then the yen was down 2 ticks, so that's just 12.50. But oil up 23 ticks, so that makes up for all those other losses. Now, if you the temptation here is, you know, to only trade one, right? Well, I'll just trade oil, right? But you don't know in advance which market is going to be the one that does well that day. All right, so the oil traders are happy today, the gold traders are not. But you put them together, and you know what we're doing here is, or what I'm trying to do, and you know doing every day, is seeing how to smooth out that amplitude of the highs and lows. So rather than a really spiky looking profit curve, you get something smoother, because since you're trading multiple markets, you can be down in one but up in another, and instead of a really ugly day here where I'm hitting some maximum loss figure, I'm basically at scratch. All right. So that's really what we're testing here in January, is the same. So these four markets, not crazy volatile like the indexes, all right, and the same machine learning model is used, and the same analytical process to determine which behaviors are best for each market is used. And then we'll see. We're going to do, because we're dealing with a probabilistic environment, you can't use one result, right? You need some period of time. So we're going to use at least January as a way to understand what is the predictive power of this approach. And really there's sort of two. Let me draw a picture here. Hang on. All right, so we're back. So what we're doing is there's two things going on. One is that we're expanding the number of markets to try to smooth out the bumps. Just logically thinking about the fact that as long as each market, from an analytical perspective, shows profit over time, that they can cancel each other out like we see today. All right, and in that way, we can reduce the overall number of like big losses by taking advantage of the fact that the expectation is that all the markets will be down is a relatively rare occurrence. In the same way that all the markets will be up would be a rare occurrence. So the idea then is you'll have the occasional max loss day when everything's down, and then you'll have the occasional just spectacular day when everything's up. But in between, you'll have a smoother ride. Okay, that's the first thing that's going on, and that's very logical, right? It's similar to conceptually similar to like the way they package housing loans together. The expectation is that not everyone's going to default, and so it's a less riskier thing to do. A bit ironic to use that example given what happened in 2008. The other thing that's going on is there's a comparison between the analytical process. So let's take a look at this picture now. So what we did for the first 6 weeks, really the first 4 weeks and then 2 holiday weeks, but for the first 6 weeks, was the analytical process is shown on the top here. where I take the machine learning model and I train it on data through the end of June. Okay, and then I run that model on data from June through, or actually from July through today. Right? And then I break that data up into 4-week buckets, and then I look at the predictions the system made and how profitable and unprofitable they were. I'm looking for the behaviors that were profitable. And then specifically what I'm doing are in each of these 6 and in some cases 7 buckets, which behaviors do we see show up more often? Okay. And that's what I started with. Show me something I'm seeing routinely, or at least more than once, would be a minimum. And this is trying to deal with the complexity and the random nature of the market. It wouldn't be unusual necessarily for a particular behavior to show up once and just make, a lot of money on a really profitable trade. But if it never shows up again, or if all the other times that it shows up you're losing money, then that wouldn't be a good one to include. So show me, profitable behaviors that occur with some level of frequency. Okay, so this is what this was. And that seemed that, using a relatively small sample size of just 4 to 6 weeks, that seemed to work pretty well. All right. And we were only trading 2 markets, oil and gold at the time. Okay. The problem that I saw, or the thing that I was concerned about, was there were lots of really nice moves that we didn't participate in. Okay. Now that's not necessarily unusual. It's silly or foolish to think that you're going to catch every move. But I wanted to see if by using that approach, I was out of touch with the current market condition. Okay, so then what I've done here that we're now testing in January is this bottom part of the screen where we're only using the last three sets of 4-week buckets. So really just 3 months of data is being analyzed. So we train the model on data through the end of September, so we have more data. But the analysis that we do is only on 3 buckets, and so it's not as easy to find common behaviors in a sample, in basically a sample size that's half the size as the previous one. Okay, but the expectation is that, or the hypothesis is that because it's more recent and because you've got more data, you can be more in touch with the current market condition. And that's what I'm doing now. So for all 4 markets, all right, I've got analysis done using the bottom half of the screen here. All right, so then what we do is we take these behaviors that the machine learning system has identified and shown as profitable in these three time buckets, and we take the model that's been trained on data through last Friday, and we look for those behaviors in live trading. Okay, and so that's the second thing that's really being tested here in January is this different analytical approach. All right, initially I was just going to stay with the 6-month thing, expand the markets out, and see. And the idea was that if I'm not catching as many behaviors, then it's okay because, if I'm not catching as many moves in a market, it's okay because I'm trading so many more markets, right? I've doubled the number of markets I'm trading. And we may end up going back to that. I'm by no means convinced that just because this new idea I've had is better. I don't know. We're testing that now. So by the way, very human thing to do is think that this new idea you have is automatically better because it's new and you've had it, right? And again, this is the rational trader. We're data driven here. So what we're doing is we're taking that approach and now applying it to live trading across 4 markets, and we're going to do that and see, do we end up, are we better off? Okay. There's a couple things. There's a ratio of the number of days where you take a maximum loss versus the number of days traded. Okay, I just call the max loss days ratio. And if you're trading a single market, that ratio is really important. Okay. And so one of the things I was doing in this initial thrust up here was to find behaviors and use trade management that reduce the number of days that you take a max loss as a percentage of the total days traded. And I was able to do that. I mean, we had the max loss days, down at 10 and 15% in some cases. And so the problem, though, is that you then, you end up missing moves that you kind of think you should get. Right? So that's just what I watched across, 4 to 6 weeks of trading. And so this experiment is, okay, well, can I catch more of those moves? Well, and we're going to find out. But what the data clearly shows is that when I do it, this with this method on the bottom, where I'm just looking for recent behaviors that did well, basically, I end up with a higher max loss day ratio. So that's okay if we smooth out the bumps because we're trading more markets. So if we look at, the euro and gold today, these are max loss days, right? So a max loss day is defined as 2 trades. If you take 2 losses in a row and you haven't made any money, then you're done for the day. This is how I trade. That's how I manage my risk. That's how I calculate my risk based upon my total capital, and it's how the simulation program runs. So if the simulation program hits the max loss amount for that day, it just moves to the next day and continues simulating. So in the simulation, what we see, if we use this first approach, we have a much lower ratio of max loss days to total days traded. We also have a lower profitability. Okay, so if we use the second method, the method in the lower half of the screen with the purple time buckets here, it's far more profitable. But you see a higher ratio of max loss days. All right. So the question becomes: all right, is it truly more profitable, or are you better off looking for common behaviors across a larger time frame? That's the first thing. And the second thing is, well, okay, if I am going to take more max loss days in a market, I know that from the analysis. Does it work out well enough that those days get smoothed out because other markets are doing well? Okay, that's the experiment that's going on right now with live trading in real money accounts. Okay, all right. So this is the first time I've explained it this way, so I suspect that needs a little polishing. In any case, today is one of those days where I've got gold and euro hitting max losses. The yen was basically scratch, but the oil made up for it. Okay, and so my total loss for the day is $10. I'm up $60 on the week. I'm just probably scratch or a little bit less than that with costs. Okay, all right, that's it for today. We will see what tomorrow brings. I think I got to check the news. For some reason, I think the FOMC is coming, but maybe that's next week. All right, take care. Aha! I knew it's the FOMC minutes that are being released tomorrow, not FOMC meeting. Though it's unclear, we have to pay special attention to the news because the normal cycle might get messed up because of this whole U.S. shutdown business, the partial shutdown of the federal government. All right. So do if you are trading actually any market, do be careful at 2 o'clock Pacific tomorrow. 2 o'clock Eastern, 11 o'clock Pacific, because of that. So for members, we would want to put blackouts around that time. And okay, so now that's it for today. Thanks.